Yesterday, January 16th, something historic took place, an event that hasn't occurred in 3 decades. For the first time since the mid-1990s, central banks around the globe now hold more gold in their reserves than U.S. Treasury debt. Read that again. Central banks officially own more gold than U.S. bonds or American debt. This moment marks a critical turning point, a figurative crossing of the Rubicon. It's the indicator that the U.S. dollar has now lost its global monopoly as the reserve currency. Essentially, the world has shifted its position, signaling, "We no longer trust you." If you fail to grasp the gravity of this change and its profound implications, you're about to receive a costly lesson, and not just financially. So block everything else out, listen carefully, and let me break it down for you and explain why this seismic shift could be the reason silver skyrockets into unthinkable territory. Let's start with gold as the cornerstone of this narrative. Since the collapse of the Bretton Woods system in 1971, the U.S. dollar has reigned as the global reserve currency. Every nation worldwide has relied on holding U.S. dollars or U.S. Treasury bonds as reserve assets. Why? Simply put, dollars are needed for purchasing oil and facilitating international trade, because that's how the system has been structured for decades. However, there's a glaring issue at the core of this system, one that many saw coming but hoped to ignore for as long as possible. The U.S. government has been recklessly printing money without restraint. The national debt keeps ballooning. $10 trillion, $20 trillion, $30 trillion, now over $36 trillion, and counting. With each new dollar printed, its value diminishes further. Understandably, foreign governments have started to grow uneasy, witnessing this unchecked fiscal behavior. The consistent bailouts, where trillions of dollars are conjured up by the Federal Reserve, have only exacerbated their fears over time. Slowly and quietly, many countries decided to safeguard themselves by diversifying their reserves, not with dollars or treasuries, but with gold. Over recent years, a list of nations including China, Russia, India, Saudi Arabia, Turkey, Poland, and others have significantly increased their gold holdings. Their actions have culminated in the extraordinary event we witnessed yesterday. Central banks collectively now hold more gold reserves than U.S. Treasury bonds for the first time in 30 years. This development is monumental, a resounding statement of distrust in the dollar. Here's why this matters. Gold is finite and tangible. It can't be printed into existence like fiat currencies or inflated beyond its inherent value. It carries neutrality, free from any one government's control, making it immune to sanctions or financial seizures. And that's precisely why it's becoming increasingly attractive to global players at a time when trust in the dollar is waning. The weaponization of the U.S. dollar has significantly amplified this trend. When Russia invaded Ukraine, the U.S. froze Russia's dollar reserves as part of its sanction strategy. Now other nations are watching closely. They understand that what happened to Russia could happen to them too, if they cross certain red lines. China comes to mind regarding Taiwan tensions. This gradual erosion of trust in the dollar's safety is pushing central banks to offload treasury bonds and stockpile gold instead. A clear vote of no confidence in America is monetary policy. This shift signals the slow unraveling of dollar hegemony on a global scale. By now, you are probably asking yourself what this has to do with silver, and here is the connection. When central banks diversify into gold, it sends ripples through markets and influences private investors, large corporations, and wealthy individuals. These entities will likely mirror that behavior by pivoting into not just gold, but also silver. Silver is often referred to as gold's little brother, or the poor man's gold. Historically speaking, when monetary systems enter periods of serious upheaval, like we're experiencing right now, silver tends to outperform gold by moving more dramatically during times of crisis. And yesterday's developments go further to emphasize silver's crucial role in this shifting landscape. On January 15th, silver prices surged to $92 per ounce, a massive leap from $30 just 6 months ago, marking an astonishing 200% surge in value over a remarkably short span. For context, these are the types of explosive price movements that they thought, oh no, the rally is over. The situation is more complex than it might seem. That sudden price crash in silver was not a typical market correction or routine profit-taking. It was a calculated move made by large commercial banks to protect their interests. Let me explain further. Major players in the banking industry, such as Bank of America, Citigroup, HSBC, and JP Morgan, have long held significant short positions on silver. This means they have sold massive amounts of silver through paper contracts without owning enough physical silver to back those positions. As the price of silver rises, these banks face steep losses, potentially disastrous losses. The numbers are staggering. According to recent data, the commercial banks are collectively short around 4.4 billion ounces of silver. The value of this short position, at $90 per ounce, reaches an eye-watering $396 billion. To put this into perspective, both Bank of America and Citigroup's market capitalizations don't come close to covering such a colossal loss. If silver remains at $90 or climbs higher to $100 per ounce, these banks could face solvency issues, putting them at risk of going bankrupt and potentially requiring government intervention to bail them out. Faced with this crisis, the banks responded drastically. In a coordinated move, they drove down the price overnight, releasing vast amounts of paper contracts during the thinly traded Asian and European markets. This triggered stop-loss orders and forced margin calls among leveraged traders, subsequently causing widespread panic and a sharp drop in prices. Their aim? To buy themselves more time by stalling the upward price momentum. However, this quick fix hasn't solved their problem, it's merely postponed it. The fundamentals driving up silver prices remain unchanged. There's still a severe physical shortage of silver, industrial demand continues to surge, and vaults remain depleted. The resurgence of prices is inevitable. When the price surpasses $95 and heads toward $100, the banks will find themselves in even deeper trouble. Their recent actions have only highlighted their desperation, and desperate measures often lead to greater instability. Some compelling evidence supports these claims of a physical silver shortage. Although the paper price for silver fell from $92 to $87 during the crash, an intriguing phenomenon occurred in the physical market. Lease rates for silver soared. For those unfamiliar, lease rates represent the cost of borrowing physical silver, such as when it's needed for industrial purposes or to cover short positions. In stable conditions, these rates are typically very low, around 0.5% or 1% annually. However, in today's market, lease rates have spiked dramatically to unprecedented levels of 5%, 10%, or even 20% in some cases. This is a clear indicator that physical supply is severely constrained. Vaults are running dry, and those who need silver urgently are willing to pay exorbitant premiums to secure it. The spike in lease rates also reflects a state known as backwardation, where the spot price of silver exceeds its futures price. This scenario occurs when buyers urgently demand immediate delivery of a commodity, rather than waiting for future contracts to mature, a glaring red flag indicating a physical shortage. So, while banks have engineered this artificial drop in the paper price to suppress the visible market rally, the physical market is sending a starkly different message. There simply isn't enough silver available. The Shanghai Futures Exchange has also signaled red alerts regarding the supply crunch. Recently, they slashed the maximum allowable position size for silver contracts from 7,000 lots to just 3,000, a drastic 57% reduction. This decision will take effect on January 19th during the 9th trading session and directly reflects their fears of running out of deliverable metal. By limiting position sizes, they aim to curb demand for physical delivery and stave off even greater pressure on their dwindling physical inventory. All these signs, the steep drop in paper prices during thin trading hours, soaring lease rates, backwardation in the market, and Shanghai's tightened position limits, paint a clear picture. A severe disconnection now exists between the artificial movements in paper values and the very real constraints in the physical market. What we're witnessing is not the end of this rally, but rather its beginning. The fundamentals remain intact and are growing even more compelling. Industrial demand is climbing, vaults are emptying, and the bank's efforts to suppress prices will ultimately falter under increasing pressure. The situation serves as a glaring warning light. It was not a question of if silver prices will rise dramatically. It is a matter of when, and when it happens, those who fail to heed these signals will be left grappling with the consequences. This is a strategic and necessary measure. The exchange is signaling an inability to manage the current volume, essentially saying, we need to slow down before the entire system collapses. If you underestimate the significance of this, then you're not recognizing the severity of the issue. Shanghai holds the title as the largest physical silver exchange globally. It's where the real price is determined. If Shanghai is running short on metal, it implies a critical shortage in the global market. This can be seen as the tipping point, the moment when faith in the paper market falters and the physical market takes control. When that shift happens, expect a dramatic surge in prices. Now, let's address the major topic at hand. Yesterday, rumors began circulating online about Rick Rule, one of the most reputable voices in the precious metals sector, allegedly selling all his silver holdings. This triggered widespread panic, with many questioning if they too should sell. Here's the truth. Rick Rule did not sell all of his silver. He sold 80% of his physical silver position, but this detail is crucial. He did so to secure profits. By selling, he recouped his original investment, covered capital gains taxes, and is now holding the remaining 20% at zero risk, effectively playing with house money. Simultaneously, he increased his investments in silver mining companies by purchasing additional shares in producers and explorers. Why? Because mining stocks offer leverage. If silver's price jumps from $90 to $150, mining stocks could yield returns of 300% or even 500%. Rick Rule remains bullish on silver. He's simply repositioning by reducing risk. and transitioning to higher leverage investments. Insiders appear to be cashing out while they still can, pulling their assets from the table as warnings grow louder for retail investors. Banks are claiming physical silver, government sales are being suspended, and vault inventories continue to diminish. If major global players are scrambling to secure physical assets rather than relying on paper claims, it raises the question, why should retail investors hesitate? This isn't merely about rising prices. It was about the threat of physical silver becoming completely unavailable. Examining recent trends, retail investors were also making waves, while institutional forces drained the vaults. Data from the Kobeck letter confirms retail buyers had been purchasing silver ETFs consistently for 169 days straight, an all-time record streak. The intensity of this buying craze aligns with historic proportions, doubling recent averages and even surpassing activity seen during the 2021 silver squeeze. Unlike the flash mobs organized via online communities back then, this shift reflects a deeper migration of capital, from stocks and bonds to hard assets. Yet, amidst this frenzy lies a critical misstep. Much of the retail investment is flowing into silver ETFs like SLV. Many assume these purchases equal owning physical silver and removing it from circulation when, in reality, they rebuying trust units backed by claims on silver stored in vaults managed by heavyweights like JP Morgan, a key player that simultaneously liquidating its own reserves. With this glaring conflict of interest, investors inadvertently support practices that undermine their own positions. The deeper issue lies within major bank holdings, particularly at institutions like Bank of America and Citigroup. Reports suggest these banks are entangled in colossal derivatives positions, with some estimates placing their gross short exposure in precious metals as high as 4.4 billion ounces, equivalent to 5 years of global silver production. These staggering figures highlight their reliance on naked short selling, trading contracts for silver that hasn't been mined or discovered yet. Now, these banks find themselves cornered. On one front, retail momentum drives up prices as billions flood the ETF market. On the other, institutional investors, whales, continue depleting physical inventories, stripping away essential collateral. This collision of forces paints a grim picture for paper markets and silver EOS availability for years to come. They are caught in a vice. If the price of silver rises to $100, the losses on a 4 billion ounce short position would be catastrophic. It would wipe out the equity of the banks. It would require a Federal Reserve bailout larger than 2008. This explains the violence of the price action. This explains why they smashed the price to $86 on Thursday. They are fighting for their lives, but the retail swarm is relentless. 169 days of buying proves that the public is not selling the dips. They are buying the dips. Every time the banks smash the price, the ETF inflows accelerate. The banks are trying to scare the public out, but they are only inviting them in at a better price. This is the unstoppable force, meaning the immovable object. The unstoppable force is the inflation-fearing public. The immovable object is the insolvent banking cartel. Something has to give. And based on the vault data from Part 2, the thing that is giving is the physical inventory. The ETF structure acts as a buffer. It absorbs the retail demand and keeps it away from the physical market for a while. The authorized participants can use leasing and accounting tricks to satisfy the ETF rules without actually moving metal, but they cannot do it forever. Eventually, the disparity becomes too large. If SLV says it holds 500 million ounces, but the vaults are empty because the silver went to Shanghai, the ETF implodes. We are approaching the moment where the paper claims exceed the physical atoms by a ratio that triggers a default. For the individual investor, this data carries a stark warning. If you're part of that 169-day streak and you're holding SLV, you are sitting in the danger zone. You're holding a receipt for a car that has already been stolen. When the squeeze finally breaks the banks, the ETFs will likely be settled in cash. They will give you dollars. But you don't want dollars. You want silver. The retail swarm has the right idea. Buy silver, but the wrong execution. They are buying the map instead of the territory. This massive inflow of capital proves that the sentiment has shifted. The public is awake. They know the dollar is dying. They know inflation is lying, and they are voting with their wallets, but they are voting in a rigged ballot box. The Friday night heist we discussed in Part 2 was the smart money taking the physical metal before the ETF holders realize it is gone. So where does this leave us for the Monday open? We have a market where the price is $90. The mint is at $173. Shanghai is at $12. And the banks are short 4 billion ounces. This is a powder keg. The retail buying is the fuse. The vault drain is the spark. And the explosion will be the repricing of silver to a level that balances the books. That level is not $90. It is not $100. In the final part of this deep dive, we are going to look at the verdict. We are going to combine the mint pricing, the vault drain, and the short position to calculate the true target. We're going to discuss the Monday gap. With all this news breaking over the weekend, the U.S. Mint repricing, the vault drain, the market is likely to panic at the open. And we are going to give you the final strategy for navigating the great repricing. The banks are trapped, the public is swarming, and the metal is gone. The only way out is up. We have arrived at the conclusion. If you have been with me through this forensic investigation, you now possess a picture of the market that the mainstream media refuses to show you. You understand the sovereign leak, where the U.S. Mint admitted the real price is $173. You understand the Friday night heist, where 4.2 million ounces were looted from the vaults. And you understand the retail swarm that has trapped the banks in a 4 billion ounce short position. The evidence is overwhelming. It is not a theory. It is a mathematical disconnect that cannot be resolved without a massive repricing event. Today, Saturday, January 17th, 2026, we are staring at the largest pricing anomaly in the history of finance. Look at the numbers one last time. The spot price on the COMEX closed at $90.14. The Shanghai price closed at $12. The pressure is too high. Something is going to break, and when it does, the price is going to explode. So if you are waiting for the perfect time to buy, the perfect time is now, because by the time it is obvious to everyone else, it will be too late. The metal will be gone. The price will be $200, and you will be kicking yourself for not acting when you had the chance. Now, let me give you one final thought. The reason the banks are so desperate right now, the reason they smashed the price to $87 is because they know what is coming. They know that they cannot hold the line much longer. They know that the physical market is going to overwhelm the paper market. They know that the squeeze is coming, and they are terrified. And when your opponent is terrified, when they are making desperate moves, that is not the time to fold. That is the time to hold. That is the time to press your advantage. That is the time to look them in the eye and say, I am not selling. So do not let them shake you out with a $5 dip. Do not let them scare you with fake news or rumors. Do not let them manipulate you with overnight crashes in liquid markets. Hold your silver. Trust the fundamentals, and wait for the inevitable moment when the paper market collapses and the physical price takes over, because that moment is coming. The central banks buying gold instead of dollars proves it. The Shanghai position limits prove it. The spiking lease rates prove it. The $396 billion loss that the banks are facing proves it. All the evidence is screaming the same message. The system is breaking. The endgame is here, and silver is going to the moon. So hold the line. Do not panic. Do not sell. And get ready for the ride of your life. This is John A.G. from Currency Archive. It is Friday, January 16th, 2026. Central banks just chose gold over dollars for the first time in 30 years. Banks are facing $396 billion in losses if silver hits 100. Shanghai is cutting position limits. The lease rates are spiking. Rick Rule is moving to miners for more leverage. And Vanek is forecasting $184,000 gold. The dip to $87 is a trap. It is the banks shaking the tree one last time before the explosion. Do not fall for it. Hold your silver. The target is $300, $500, maybe more. The force majeure is coming. The endgame is here. Remember to like, subscribe, and share. Hold the line. Do not let them steal your